On the 22nd of December 2008, a well-known French investor, Thierry de la Villouche, entered his office on the 22nd floor of a Manhattan building. The scene was quiet, a tragic calm settling over the skyscrapers of New York City. Thierry locked the door, sat down in his chair, and rested his legs on the desk. In his hand, he held a bottle of sleeping pills. He took them, methodically, with a heavy heart, and left a note for the world to find. At 65 years old, he felt there was no other way. Just 11 days earlier, the world had been shaken by the arrest of the infamous American fraudster, Bernard Madoff. Thierry, along with countless others, had been caught in Madoff's web of deception. He lost up to $1.4 billion, a catastrophic sum that pushed him beyond the edge. Thierry's death wasn't an isolated incident. It symbolized the devastating fallout from Madoff's colossal Ponzi scheme, which resulted in over $50 billion in losses, leaving behind a trail of ruined lives, broken families, and financial destruction. To understand the gravity of Thierry's despair, we need to dive deeper into the mastermind behind it all, Bernie Madoff. The name, now synonymous with fraud, echoes through the annals of financial history as perhaps the most cunning and successful swindler to ever operate. He built a scheme so elaborate, so deceptive, that it remained hidden for nearly 4 decades. The birth of a deception. The story begins in the late 1960s when Stanley Chase, a businessman from the East Coast, decided to retire from the clothing industry. Having sold his shares in his family's manufacturing business, he was eager to invest his newfound wealth. With a trusted friend, Marty Gold, by his side, Chase was introduced to a young and ambitious stockbroker named Bernard Lawrence Madoff. At the time, Madoff was just 32 years old, the owner of a brokerage firm called Bernard L. Madoff Investment Securities LLC, founded in 1960. Madoff, with his sharp intellect and convincing charm, dazzled Chase with seemingly extraordinary profits. Investors trusted Madoff because he promised something too good to pass up: guaranteed returns through a strategy he claimed was based on stock market arbitrage. For decades, no one questioned this claim. It seemed Madoff had cracked the code to financial success, generating consistent profits year after year. The allure of Madoff's returns was irresistible. Stanley Chase was one of the first to fall under Madoff's spell, but certainly not the last. What no one realized at the time was that Madoff had never actually invested the money. Instead, he was running a classic Ponzi scheme. The Ponzi illusion, named after Charles Ponzi, who became infamous for this fraudulent investment method in the 1920s, a Ponzi scheme works by paying returns to earlier investors with the capital injected by newer investors. Madoff perfected this model. Investors were none the wiser as they continued to receive their supposed profits, which were nothing more than smoke and mirrors. Stanley Chase, utterly convinced by the illusion of success, continued to pour his money into Madoff's fund, eventually opening accounts for his 3 sons. Over time, he established a series of feeder funds, intermediary entities that pooled capital from investors and funneled it into Madoff's empire. The first was called the Lambeth Company, followed by 2 more, the Brighton Company and the Potham Company. These feeder funds played a crucial role in keeping Madoff's Ponzi scheme alive, gathering billions from investors all over the world. But Chase wasn't the only source of funds. In the 1970s, another wealthy businessman, Carl Shapiro, joined the ranks of Madoff's victims. Known as the Cotton King for his success in the textile industry, Shapiro was introduced to Madoff by a man named Michael Lieberbaum. Initially, Shapiro gave Madoff only a small sum to manage, but after receiving impressive returns, he entrusted Madoff with a larger portion of his fortune. Shapiro's endorsement, combined with Madoff's growing reputation, attracted even more investors. By the mid-1970s, people were clamoring to hand over their money to Madoff, believing in the myth of his unfailing success. The genius of Madoff's fraud. Madoff's genius lay not just in the mechanics of the Ponzi scheme, but in how he projected trustworthiness. Unlike most con men, Madoff didn't aggressively solicit investments. Instead, he created an aura of exclusivity, as if people were lucky just to have the opportunity to invest with him. His clients, many of them rich and well-connected, believed they were part of an elite club. As word spread of Madoff's guaranteed returns, often between 10% and 14% annually, more investors came knocking at his door. However, by the mid-1980s, as financial technology advanced, Madoff could no longer rely on his original claim of arbitrage trading to explain the consistent returns. The stock market had evolved, and sophisticated computer programs had all but eliminated arbitrage opportunities. So, Madoff shifted his narrative. He began claiming that his fund employed a split-strike conversion strategy, a complex options trading technique. This was nothing more than a smokescreen, but it was enough to keep investors satisfied and the SEC at bay. For nearly 4 decades, Madoff continued to lure investors into his fraudulent scheme, always paying out returns from new investors' money. His empire seemed unassailable. That is, until 1999, when a man named Harry Markopolos entered the scene. Markopolos, an analyst working for Rampart Asset Management, was asked to look into Madoff's fund by his colleague, Frank Casey, who had heard about Madoff through a French investor named René Thierry Magon de la Villehuche. Villehuche, the same man who would later take his life, had boasted of Madoff's astonishingly consistent returns. Markopolos quickly realized something was off. After analyzing Madoff's financial data, he concluded that the returns Madoff was reporting were mathematically impossible. In 2000, Markopolos compiled a detailed report, outlining his concerns and presenting his findings to the U.S. Securities and Exchange Commission, SEC. His report, titled "The World's Largest Hedge Fund is a Fraud," was met with indifference. The SEC ignored Markopolos' warnings, allowing Madoff to continue his deception for almost another decade. The downfall. The end came suddenly in 2008. The global financial crisis was wreaking havoc on markets, and investors everywhere were panicking. As banks began to fail and markets tumbled, Madoff's clients, too, became nervous. They rushed to withdraw their money, expecting Madoff to deliver as he always had. But this time, there was no money left to give. In December 2008, facing mounting withdrawal requests he couldn't meet, Madoff finally confessed. He called his 2 sons, Mark and Andrew, to his apartment and revealed the truth. He had been running a Ponzi scheme for years, and the total losses could be as much as $50 billion. Shocked and betrayed, his sons immediately reported him to the authorities. On December 11, 2008, Bernie Madoff was arrested at his penthouse in Manhattan. Over the following months, the full scale of Madoff's fraud became apparent. Investors from around the world had lost their life savings, charities were bankrupted, and even banks had been swindled. In June 2009, Madoff was sentenced to 150 years in prison, a sentence meant to symbolize the enormity of his crime. The repercussions of Madoff's scam were far-reaching. His eldest son, Mark, unable to cope with the shame and fallout, tragically committed suicide in 2010. His younger son, Andrew, died of cancer in 2014, leaving behind a legacy stained by their father's sins. Madoff himself died in 2021 in a federal prison where he had been serving his 150-year sentence. The story of Bernie Madoff serves as a grim reminder of the dangers of blind trust and the catastrophic consequences of financial deception. Thanks for watching. Don't forget to like and subscribe our channel.